Good evening, dear students. Most welcome in my class. I hope you are listening and noting down what I am giving you very slowly and lucidly. In the second class on holding company, I am again explaining the rules suggested for preparation of consolidated balance sheet. You need, I know, some physical class in the classroom for getting solved the problems on blackboard. But under this lockdown period, it is not possible to reach in the physical classroom. That's why I'm trying my level best to give the cognitive approach. From that approach, if you assimilate and open your books at home and try to solve numerical problems, I am definitely confident enough that my beloved students will be able to solve a galaxy of problems. But there are bounces, there are hitches, there are problems. Without problems, nothing is happened effective in life. So you feel free to ask question after assimilation of my theoretical lecture and prepare for the practical calculation of the problems at home. Okay. So first rule. See, in the consolidated balance sheet, investment of the holding company in the equity shares, as I explained in the first class, that the equity shares of the subsidiary company is replaced by the assets and liabilities of the subsidiary company. Again, I repeat, in the consolidated balance sheet, that is CBS, investment of the holding company in the equity shares of the subsidiary company is replaced by the assets and liabilities of the subsidiary company. So, some sort of description, explanation is necessary. I am explaining this point. You may note down in your exercise book the holding company in its own balance sheet shows the shares acquired in subsidiary company as investment. It is represented by the net worth or equity of the subsidiary. Okay. And the holding company share in his equity in such equity, where equity equals to share capital plus net reserve and surplus on the date of acquisition of control. Date of acquisition of control is very important thing. On the date, on the moment the holding company acquires the control of the subsidiary company. After this date, all the transactions related to profit or losses should be noted carefully, and before this date of acquisition, all the profits and losses should be noted carefully. If cost of investment is more than equity, I told you earlier, the excess represents goodwill. Okay, and this goodwill should be shown in the asset side of the balance sheet. it will appear as an asset in the CBS. If cost of investment is lower, the difference has to be shown as capital reserve in the CBS. I told you in the first class. If you calculate by your own hand, taking any problem, then this is not very tough to clear. Okay, it is easy. You take your patience, you open your textbooks, try to solve any problem what is appeared in the last year BCom or any exams, yes, or chartered exam, whatever it may be. But particularly if you follow the BCom degree course problem, then definitely you will be able to solve this. Second, if all the equity shares of the subsidiary company are not held as investment by the holding company, the outside shareholders' interest in subsidiary company to be shown separately in CVS as minority interest. Okay. If the holding company does not own all the equity shares of the subsidiary company and is only a majority shareholder, the outside shareholders are called minority shareholders. So their interest in the business of the subsidiary company is called minority interest, which is equity held by outsiders. All assets and liabilities of the subsidiary company should be included in the CBS at their full values. The minority interest should be shown as a separate item on the liability side of the CBS. I told you in the first class. Again, I am repeating because this holding company is very important chapter for the 6th semester students. Minority interest to be calculated only on the date of preparing the CPS equals to nominal value of shares held by minority plus proportionate shares of subsidiary company's profits and reserves on the date of CVS. Proportionate shares of the subsidiary company's losses on the date of CVS. So you get 2 points very clear: cost of control and minorities interest. In the first class, I have suggested 9 steps. So within that 9 steps, everything is explained. If you study very carefully, you will find everything is explained very lucidly. Third point, pre-acquisition and post-acquisition profits, reserves, losses of subsidiary company to be segregated. That means pre-acquisition and post-acquisition profits, reserves or loss of subsidiary company should be distinctly separated. Why? If control is acquired by the holding company on the date of preparing the consolidated balance sheet, all profits, reserves, etc. of subsidiary company are called pre-acquisition profits or capital profits. Otherwise, profits, etc. of the subsidiary company up to the date of acquisition of control by holding company are pre-acquisition profits. So, post-acquisition profits and pre-acquisition profits with reference to the date of acquisition is very significant for the preparation of CBS. Whereas profits etc. of the subsidiary company subsequent to the date of acquisition of control are called post-acquisition or revenue profits. All profits, reserves, or losses of the subsidiary company should be apportioned utilizing available information or on a time basis. Okay. The holding company share in the pre-acquisition profits etc. of the subsidiary company should be adjusted against the cost of control. Holding company share in the post-acquisition profits, reserves etc. are shown in CBS under different heads like general reserve, profit and loss account, etc. Such allocation is not needed for minority interest. As already said under Rule 2, above minority interest includes all profits, reserves, losses, etc. of subsidiary company up to the date of CBS. Okay. Next come fourth, effects of intercompany transactions or intercompany branches should be eliminated while presenting CBS, that is consolidated balance sheet. Intercompany transactions or intercompany balances should be eliminated. As companies under the same group may have transactions within themselves, such transactions may lead to intercompany debts and acceptance. An intercompany balance appearing as an asset in the balance sheet of the company may be shown by the other company as its liability. Okay. This should be eliminated from both sides of the CBS. Otherwise, the same item would appear on both sides. This may be explained further as follows. What you have to note very carefully. Number one, intercompany debts. For intercompany sale, the debtors of one company will include some amount due from the other company. Similarly, the other company has a liability to the seller company. In the consolidated balance sheet, the amount of the common debt should be deducted from the merged or consolidated amounts of book debts and creditors. Okay. The balances of intercompany debts may be unequal also. Suppose debtors of holding company includes 15,000 due from subsidiary company, whereas the creditors of the latter company includes 12,000 due to holding company. In that case, rupees 15,000 should be deducted from the merged amount of book debts and rupees 12,000 should be deducted from the merged amount of creditors in the CBS. The difference in amounts rupees 3,000 should be shown there as an asset which may be accounted for as goods in transit or cash in transit. Profit included, if any, should be eliminated from the goods in transit. Is this clear? Next, number B point. Intercompany acceptance. Bills receivable of one company and bills payable by another company may include the amount of mutual acceptance. This should be eliminated from both sides of the CBS. If the creditor company discounts or endorses any mutual bill, the discounted bill will appear as liability in the CBS. This is only the undiscounted or unendorsed portion of the bill can be set off. Usually the company which discounts any bill shows that as a contingent liability. Intercompany acceptance, if discounted, will not be shown as a contingent liability in the CVS, that is consolidated balance sheet. So treatment for unrealized profits, intercompany adjustments, intercompany profits, these are very important. You have to note carefully. As preparation of a consolidated balance sheet is not compulsory in India, and due to the absence of any related accounting standard in India, difference in the treatment of unrealized profit was very prominent among the Indian authors. But now that accounting standard, that is AS21, has become mandatory for enterprises preparing consolidated financial statements, we should apply para 16, which clearly states that unrealized profits or losses resulting from intergroup transactions should be eliminated in full. In these circumstances, what I prefer to follow the fast approach. The reasons are: a consolidation is made for enjoying the benefits of merger without foregoing separate existence. If some amount of profit remains uneliminated, full benefit cannot be enjoyed. Total liquidity and solvency of the group can be properly ascertained only if the full profit element is deducted. Consistency in valuation, which has been advocated by AS2, Accounting Standard 2, regarding valuation of inventories can be observed better if the entire profit element is deducted. Proposed dividend, treatment of proposed dividend of holding company is also important. As you know, for any company that proposes any dividend should pass the entry profit and loss account debit to proposed dividend account. Proposed dividend appear as a liability. In this class, I have to give you some points about holding company accounts. Indian Companies Act, Accounting Standard 21, AS21. We should note that according to the Indian Companies Act, the preparation of consolidated financial statement is not compulsory. I have told you in the first class and this class also. But section 212, that is 212 of this act, requires that in the balance sheet of the holding company or parent company, certain particulars should be included regarding its subsidiary, like statement of holding company's interest in subsidiary under section 212 subsection 3, statement of changes under section 12 subsection 5, etc. The parent company and its subsidiaries should represent a separately distinguishable economic group. For this reason, Accounting Standard 21 stipulates that if there is a consolidation of the financial statement of a group, the accounting standard should be followed. Preparation of consolidated financial statement, AS21 para 789. Procedure of consolidation, AS21 para 13, should be followed carefully. Minority interest, para 13D, 13C, 25 and 26. Lot purchase of shares, para 15. Intergroup transactions and resulting unrealized profit or loss, para 16 and 17. Uniform accounting policy, para 20. Consolidation of financial statement. Certain points may be noted. Number one, a holding company may be called a parent company. It holds majority of the voting shares of another company or companies. Majority means more than 50% share. But it may even be 100% or absolute majority. Then what absolute majority? When a company holds 100% share. That is absolute majority. The company whose shares are acquired by holding company is called subsidiary company of the holding company. Does a holding company invest in the voting shares of subsidiary to exercise significant control over the subsidiary company? It is a form of combination without merger. It is called group merger. The central point in the relationship between these companies is control. Equity shares are to be recognized as voting shares. Second point, a holding company can have more than one subsidiary company. Again, there may be a chain where one company is a holding company of a subsidiary company, which may again be the holding company of another company, and so on. That is chain holding. There may be also cross-holding, where the subsidiary company also is the holder of the majority of voting shares in holding company. But except in cases stated in section 42, cross-holding is not permitted. In any case, the companies form a group. The Indian Companies Act does not require consolidated financial statement of the group. But if consolidation is made, that should be made according to AS 21. Next, the cost of investment made in subsidiary and the portion of equity acquired there on the date of investment are eliminated in the consolidated balance sheet. If cost of investment is more, the excess should be recognized as goodwill. That is an asset. If portion of equity acquired is more, the difference should be recognized as capital reserve, as a liability. So next, five assets and liabilities of holding company and subsidiary company are combined on a line by line basis. It does not depend upon the portion of equity acquired. Where the holding company is a majority shareholder but not absolute majority, the holders of the remaining of voting shares are known as minority shareholders. Their shares in the net assets of subsidiary company should be shown separately as a liability as minority interest. Next, intra-group balances and intra-group transactions are eliminated. Thus, debtors of one company related to creditors of other company, intercompany bills receivable and bills payable, etc. are set off. Next point, unrealized profit or losses arising from above transactions and included in carrying amounts of stock, etc. are eliminated in full. Next, the holding company holds majority of the voting shares or equity shares of the subsidiary company. It may also invest in preference shares of or debentures of the subsidiary company. Sorry, some technical disturbance was there. Excuse me. So, next, the date of acquiring majority in voting shares of subsidiary company is recognized at date of acquisition. Any reserve, profit, or loss of the subsidiary company before the pre-acquisition date should be noted as capital profit, and that should be adjusted against the cost of control. And after the date of acquisition, that should be adjusted as post acquisition profit. Any reserve profit or loss after that date is called post acquisition or current profit loss. Proper allocation between pre-acquisition items or post-acquisition item is needed for adjustment at all necessary steps. The Indian Companies Act does not provide any format of consolidated balance sheet. Schedule 6 is usually followed to prepare it. You can prepare consolidated balance sheet horizontally following Schedule 6 Part 1 of the Companies Act, or you can prepare consolidated balance sheet in the vertical format also. So you try to solve practical problems. If any problem, you feel free to ask me during this lockdown period through WhatsApp. But your feedback is necessary. Your feedback is necessary. You will be able to give me feedback if you practice. If you don't practice and don't listen the lecture, then no use of this. So when we'll be meeting in the classroom or in the college, we can physically solve in the classroom, or practically we can interact in the tutorial class format. The practical problems can be solved, but in the meantime, I hope you will realize, assimilate the theoretical part what I have given to you. and any problem, feel free to ask me. If you don't give me feedback, then what I will do, you will reciprocate your views. Then what is the defects? What are the loopholes? What I have to cover? What I need to give you further? That's why I need your feedback, your questions. My dear students, stay fit, stay healthy at home. Thank you. Thank you. Good day. Enjoy.